Hello, in today's video, I will be sharing with you how to know institutional order flow. And the reason you have to know this as a trader is because you want to be at the right direction in the market. For example, if you wake up in a particular day and you want to trade, you have to know the direction where you will be taking your trades and the target where that trade is likely to meet. And that is why you need to understand institutional order flow. If you stay to the end, I'm going to show you a trick that you can use to identify when this order flow is starting. And if you are new, make sure you subscribe, like this video, and let the algorithm recommend this to other people. So without wasting time, institutional order flow is simply the flow of orders by the big banks, okay, the smart money. Where are they taking orders? Are they bullish or are they bearish? If they are bearish, then we have a bearish institutional order flow. If they are bullish, we will have a bullish institutional order flow. Now, it's not all about looking at the overall trend of the market, because a trend can be bearish, but the order flow for that particular time frame we are looking at or that particular period will be what? Bullish. I'm going to show you why. Because there are two types of institutional order flow. We have the major institutional order flow and we have the minor institutional order flow. The major institutional order flow are those order flows that are in line with the overall trend. Okay, for example, Euro USD has been bearish ever since. So that bearish flow is simply a bearish order flow, major institutional order flow, and that is where they are taking price of Euro USD to the downside. Now, the second type is the minor institutional order flow. The minor institutional order flow are simply orders that move to mitigate a certain demand or supply level before continuing the major institutional order flow. And the reason for that minor institutional order flow, or I call it the counter order flow, is to manipulate and take out early buyers or sellers. Is a way to clear liquidity, because the market needs liquidity to move. If the market has been extended to the downside, at a point it will get exhausted, and therefore it needs more liquidity to move, just like a moving vehicle. It needs to refuel, and in order to refuel, it has to go back, retrace, and that's where the retracement comes back, which is also an order flow. The reason why they are moving up or down towards that mitigation point is to clear out liquidity. Now let me show you on this hypothetical illustration. Now you see here the market has broken structure here based on a reversal here, and now we are looking for a bearish institutional order flow. Market came down, breaking this low, trade up, move down. Now this order flow is bearish, okay? The leg up here is the minor institutional order flow, because the banks or the smart money push price up. When they push price up, that is the order flow for the day, whether you like it or not. And now, why are they pushing price up? To clear out this liquidity up here. The reason for that is to clear out this liquidity, to get fuel, probably mitigate into a supply zone, and then therefore move to the downside. You can see, so that is the bearish institutional order flow. Market keep printing highs and lows. These highs and lows are simply liquidity. Okay, they engineer liquidity to allow you and I, the retail-minded traders, to place in their buy or sell order. Whereas market comes back, take out this liquidity, and then continue the order flow to the downside. It brings liquidity in form of what? Minor institutional order flow. And most times, the major institutional order flow leaves liquidity behind. Okay, what I mean is, for example, in a lower time frame, we might have a form of liquidity this way. Pardon the drawing. Okay, now all these highs, which is the internal structure liquidity, are liquidity. Okay, the internal structure, the highs and lows are what? Liquidity, which the major institutional order flow creates. And therefore, those liquidity, if not all, some of them will have to be cleared to continue the push to the downside, because not everyone will enter at this spot. Some will enter here, some will enter here, some will enter here, therefore creating what? Liquidity for the banks. If the price comes back to those areas, for example, some traders will be looking at the demand zone here and supply zone here, or other block in here, which is liquidity that will be taken. And once that liquidity is taken, market will continue in the original major bearish institutional order flow. Move up, creating liquidity, then breaking down. And that is why you need to understand that once liquidity is taken, you can anticipate for the continuation of the overall major institutional order flow. Same thing with the bullish side. The market was in bearish order flow. All of a sudden, we have a change of market structure to the upside. There was a minor order flow to mitigate. Okay, price needs to mitigate because what they opened here was a loss, and they need to mitigate it to manipulate people out. So once price comes back, that is the minor order flow, and you can also trade in that order flow. It comes, take out liquidity here, mitigate the demand zone, and then continue the order flow. And mind you, within this push up, in the lower time frame we have internal structure. Okay, even in the higher time frame we might have some minor structure here, which I will show you on the chart. Now, as price move, it gets exhausted in here, exhaustion. So what will happen? They will change the order flow, okay, and then whether it's a minor order flow to push price to take some liquidity to fuel this movement. Okay, so when price comes down, clearing liquidity and mitigating some form of demand zones in here, price will move to the upside, breaking structure. Okay, that indicates that the order flow is still bullish. But you can also trade the minor order flow. This minor order flow duty is to mitigate, okay, and also connect liquidity. It has two things to do. It has to mitigate and also collect liquidity. Okay, because liquidity is what the market needs to move up and down. So in that case, it moves now to also clear those that think we are having a reversal in here, or those that trade trend line will be taken out, okay, and price will continue moving in the intended direction of the major order flow. So what are you supposed to do as a trader? You are supposed to identify the major and minor order flows, okay? Where are the banks, the big players, moving price to? If it's bullish, you position yourself, create a trading plan to get in and move along with the trend. If it's bearish, you do likewise. Now, if you are trading the minor institutional order flow, that means price wants to come down to mitigate some areas and also grab liquidity. You can also anticipate that. Though that might be difficult sometimes, but with practice, backtesting, forward testing, you are going to have yourself rounded. You are going to be able to understand how to go about the market. So without wasting time, let's look at some chart in here. Okay, this is a Euro USD pair. Now, I don't want to go too far. You see, this leg here that created here, the leg that was created here is what is an order flow, major order flow, because the Euro USD has been bearish since, okay, almost a year now. So you can see when this prints down, what does it do? It creates internal liquidity. Okay, here we have internal liquidity here. We have here. Okay, so your duty as a trader is to anticipate which of these liquidity will be taken before moving lower, because this market can't go lower except it creates or except it takes liquidity. And you can see it came up and cleared this liquidity here that was created here with this point, and then continue moving to the downside. All of these are simply liquidity engineering, trying to induce traders to buy and sell, support and resistance trend line, and whatever patterns they see on the chart, they intend to go in and then trade. But you shouldn't be doing that. You should be able to know the direction where this market is going to, and sometimes you have to be patient. Okay, wait for price to come to your level that you feel price to get to, and then you continue that order flow. Always try to trade in the direction of the trend. And if you have a good understanding of the minor institutional order flow, you can also trade in that direction. So you can see market growth structure here. But before you did that, what happened? So before that, what happened? He created some internal structure here. This is the major name here. I did a video on market structure. Okay, you can watch that video. I'll put it in the description. It moved to the downside, creating some internal structure, which is liquidity that price needs to pay. Now the question is, price may not come back to this top and then take it. Your duty is to, whenever price is taking in liquidity, especially in this case, in premium zone, you can anticipate to move. Okay, you can anticipate to move to the downside. That okay, the institution has taken and collected the liquidity that they need to continue moving this price to the downside. Okay, these are what I do most times. Okay, I wait for liquidity to be taken before you continue moving to the downside, and also to mitigate some form of supply zone in this case. So what you need to do is to backtest. You can backtest all of this. Okay, you can see market came back to clear out all this liquidity that have been built, and then mitigate, form of what supply zone to continue moving to the downside. And this is what happens every day in the market. Market is fractal. What happened on the 4-hour is something that happens within the lower time frame. Just that the noise within the lower time frame is more, the structure change is more. So you have to be very, very careful. And that's why I use the lower time frame for execution. If you need to understand more on order flow, I will see you here.